All right, good morning. Welcome back here to Trader Minute. Great to have you aboard. We've had a couple stocks report earnings here of late, and there are more companies that I want to talk about going forward, but there are two that I want to talk about here this morning. One briefly and one in a lot more depth. Here's General Electric. General Electric gapped down this morning on their earnings. They've been kind of rallying pretty much all morning. New CEO, still in his first 100 days. It's been a train wreck here for General Electric. We talked about it a little bit yesterday. And I mentioned that in the earnings I wanted to see him kitchen sink it. Basically, just throw all the bad stuff in there and get it over with. Right? You know, enough of this slow bleed stuff. I don't quite think they kitchen sinked it. But I do think they did something that investors have been worried about for a long time or expecting for a long time, and they've delayed it and delayed it and delayed it. And that is they slashed the dividend. They cut the dividend down to a penny a share. You know, monster cut in the dividend. Going to save them something like $4 billion, something of that number. But it's indicative of what a company has to do when they've kind of gone into this shrinking mold that General Electric is in. Interesting comments from the CEO. Comments that you would expect to hear. You know, some confidence. Talks about, you know, GE's valuation. Talks about kind of turning things around. Talks about holding people accountable. And, you know, some relatively positive things. Therefore, for General Electric, I think this is one of those elements or one of those stories here where in 6 months we might be able to say, look, this was an absolutely great buying opportunity. But I don't think it's the best time to jump in. I think this is something where there's still a process to go. There's still a process that needs to happen. This may be enough to get some of the shorts to jump out and some of the shorts to move on. But there's more of a process needed here. General Electric, in how they're positioned right now and some of the stuff they've said and what they're going to be looking to do, they're probably not poised for a major rally based on earnings and fundamentals for another 6, 9, 12 months, assuming, you know, things progress very well for the company. And so, yes, ultimately, could this be a buy opportunity? Sure. I think you could buy it here and you're probably going to be okay over time. But it's probably still a little bit early, you know, if you're looking to absolutely nail the bottom or looking to ride the next big move up. If you look at it, you look at what they're doing, this is not a $20 stock. It's not even a $15 stock with how they've cut some things. And so there's going to need to be some digestion. Yes, we've had the dividend cut, you know, and that can oftentimes mark a bottom for a company. But at the same time, there's not a lot to rally around. There's not a lot to get excited about, you know, here with them. So, yes, did they kitchen sink it? Not completely. But, you know, it is something where I kind of look at it very neutrally right here. Something I'll continue to keep my eye on and look for some signs of life. But it's still going to need some period where they're actually talking about improvements, not just cost cutting, not just, you know, pulling things back, but actually talking about improvements. And, you know, in this market environment, you know, I think we're going to be talking about companies with valuations getting bought up, and I don't think you can make a very compelling argument for General Electric's valuation here just yet. So, you know, we saw GE here this morning. You know, that has come in, and, you know, that's happening here. So, long way to go. Okay. Now, another stock here that I think, you know, if you kind of like this bad story turning into good story, or bearish story turning into bullish story, I think is much more compelling than GE right here. Meaning I think it's in that, meaning I think it's gone through much of the process and is, coming out of it. There's American Airlines. There's a company that, has taken it on the chin, has dropped here from the upper 50s down to the lower 30s. Here in the course of 2018, been one of the worst performing stocks in the market during 2018. We talked about it back here in the earnings reports. These airline companies started talking about market share, capturing market share. We talked about it. That's just terrible for the airlines. That brings up terrible memories for investors. For many, many years, airlines, they chased market share with no regard for expenses, with no care for profit. They just looked to increase market share and grow the business. And what would happen is they would just spend and never turn a profit. Led people like Warren Buffett to make comments like, if you ever want to be left with $1 million, invest $2 million into an airline. Right? Some very bearish comments in terms of, the overall airline sector. But it's because they chased market share over all else. And, it left many of these to go through bankruptcies and all of that. And we've seen many of them in the space. I saw beginning of this year, end of last year, beginning of this year, when these companies are talking about chasing market share, investors just, wow, ouch. This quarter, American Airlines CEO sounded very differently. He was beating a different drum, singing a different tune. He came out and basically said, look, we didn't do as well this quarter as we wanted because of fuel cost. Fuel cost being on the rise. He's absolutely right. Fuel cost on the rise, and we can see this in expenses. If we come in here and we just look at expenses for American Airlines, oops, there we go. Expenses here. Sometimes when you look at these, one will work, one won't. And it looks like this one is not wanting to show it. Let me get the exact one because I want you to see this. I think this is an important element here. Yep, total expenses, TTM, should be coming up, but it is not. So I'm going to relog into Y charts here. I say should be because I do have it up on my other computer. So let's try this again. But I think this is paramount to the story. So we're going to come into total expenses, TTM, and we're going to look for American Airlines, and there we have it now. Take a look at what's been happening with expenses. On the rise, on the rise, on the rise, right? Kind of what we want to see with revenue, but it's happening with expenses, right? They just continue to go up. They talked about why. They talked about fuel cost, and we have seen fuel cost, be very high here on a relative basis, and pushing things up. Well, let's take a look at some other things. Let's go revenue. Is this a company that's shrinking in revenue? Well, no. Yep, their expenses are going up, but so are their revenues. The problem has been their expenses have been going up faster than their revenues. Typical airline element, chasing market share without any regard for the expense side of things. But their CEO came out and spoke very differently, said they are looking for a $300 million cost improvement going forward. They are canceling unprofitable flying. They're implementing a new cost management model. They also raised their guidance going forward. And then they talked about revenue growth. They didn't talk about revenue growth as, hey, we're going to spend here and do this and that and that and this. We're going to chase down market share. They said, look, we right now in some of our major hubs have some high margin growth opportunities that aren't going to cost a lot of money, that are going to put nice revenue growth into our bottom line. Totally different tune. More responsible, more calculating, more revenue versus cost conscious. And a very big difference in the tone, very big difference in the approach. I'll argue with you that this is a changing point. This is a game-changing point for these airlines. That if airlines are going to go and approach the business this way rather than chasing market share, these companies are severely undervalued. Now, we can't make a great valuation argument for these companies. If we come into something like price to book value here on American Airlines, it's pretty much what it's been. If we come in and take a look at a PE ratio, right? We just come in and look at what the current PE ratio is. We're talking about a PE ratio that's 1375. It's not exactly cheap. It hasn't been getting cheaper as the stock's been going down, like we see with many. But if we do look at the forward PE, basing forward growth in here, it's one of the lowest numbers that it's had in a long, long time. This is compelling. This is very interesting, especially when speaking to the future of the company. And I think this is one of the first earnings seasons where we have seen collectively from these airlines companies a more responsible, more cost-conscious approach towards the business going forward. And let's face it, the business is strong. The business has continued to grow. The revenues have continued to grow. This isn't something where, people are stopping flying, they're not flying anymore, and all of that. They're going to do things like adding, TV service to, a bunch of different flights. Their Latin American growth is really strong right now. They have these bright spots, and they have been bright spots, but they've been clouded by this element of chasing market share. And so when you come in and start to look at some of these airline companies, to be able to look at them and say, hey, you know what? Bottoms are likely in, I think is a very compelling argument. Now, does that mean you go and buy it right here, right now, and chase it down? Not necessarily, right? I mean, you still need to find a chart with a good risk-reward opportunity type of thing if you're going to trade options on it. But, you take a look at something like United Airlines, which is, outperformed, or United Continental, which has outperformed during this time period, right? You compare that to something like a Southwest that's really underperformed heavily. Who do you want to go after, right? Who do you want to trade? For me, this is one where American's always been my favorite to trade, but I do think Delta has some significant upside. UAL probably has, some of the safer upside out there. And then, if you really want to get aggressive, you get with some of these more regionals like the Alaska Airlines, the Hawaiian Airlines, HA, or, even something like a Southwest here overall. And that's kind of where you get more aggressive. But, in this environment where we're going to be talking about, fuel costs coming on down, right? And fuel cost, dropping, which is going to be a theme going forward. I think you take a look at a JetBlue. That's a positive story for them. I think it's a very positive story for American Airlines as two of the, bigger beneficiaries if we are talking about fuel costs on the decline. So American Airlines, a company, I think they're changing spots here with earnings. And, this is not based on its earnings reaction. They reported earnings already. This isn't something that today they reported earnings. In fact, if you want to take a look at the, earnings reaction when it comes to, American Airlines and some of these other airlines, you can take a look. I mean, the earnings were on the 25th, right? And if we just click on annotate here, they were before the market on the 25th. So let's come in here to the 25th. Let's see, that was this day right here. Okay. They had a big slide, and then they popped back up and they erased that slide. The next day they gapped down and they rallied with the market, and then yesterday they gapped up and they sold off with the market, right? They are, this isn't something where you can just look at the earnings reaction and go, oh, it was a big positive reaction. Something must have been great about the earnings, or vice versa. But this is one that I think if the market environment were a little bit different, they would have been rewarded substantially to a much, much greater degree here overall. And I do think this is a company that could have a very, very strong next 2 to 3 months here in them. If we come in and take a look at some of these airlines and the seasonality with them, which I think is important right now, right? I think is very important right now. But you look at airlines over the last 5 years, November, December have been great months for them. If you go out longer, you go out something like 20 years, what are their best months? November, December, October, we've had a correction during that time, but we're getting into the best seasonal period for airlines right here, right now. We have some very positive earnings reports, with some of these companies. Yes, they still have some concerns, and yes, fuel costs are high, but which way are fuel costs going? I mean, here's just the price of gasoline. Right, you can see what it's done here over the last month. So, bonus for the airlines here overall. So, to me, one of the stronger bullish stories to come and emerge out of this earnings period here so far. Okay. So that's a little bit on General Electric, a little bit on American Airlines. Again, we have a ton of earnings still, set to hit the market, and those will be coming out here this week. As they do, I'll continue to kind of highlight and show some of these, and these are things that shape and mold my watch list. It's not something where I go, ooh, earnings great, I'm gonna go buy it right here, right now. I'm not in American just yet, but we'll be looking for a point to get in. But it has been added back to the challenge watch list, and looking forward to trading that going forward. Thanks for hopping on. Have yourselves a great one, and we'll talk to you later. Take care.